Everyone says you should start investing, but nobody really explains how to do it in a way that actually makes sense for you. And then what happens is you start investing, the market drops, and you panic. So let's talk about investing, but actually make it make sense. If you're new here, I'm Brianne. I'm a CPA, and I like to make videos about personal finance in a way that actually makes sense and can actually fit your real life. Investing is one of those things that actually sounds really simple until you start doing it. Because when people talk about investing, they skip steps. They'll say things like just invest in ETFs, just invest in the S&P 500, or just let compound interest do its thing. But people rarely explain the first step that you need to get there. Like, where are we investing? Through a bank, through a brokerage? And what accounts are we using? Are we using a TFSA? Are we using an FHSA? Or are we using an RRSP? And even if you figure all that out, now you're sitting there wondering, okay, but what should I actually buy? So instead of starting out with what to invest, I want you to start out with yourself first, because investing is not one size fits all. The first thing you need to figure out is your risk tolerance. And this is basically asking, how am I going to react when things go down? Some people are more risk averse. They don't like seeing their money drop, so they rather stick to something more stable, even if it means it might grow a little bit slower. So that might look like high interest savings, GICs, government bonds, or more conservative portfolios. Some people are in the middle. They're risk neutral. They're okay with some ups and downs, but they're looking more for balance. So they may be in a mix of stocks and bonds. And then you have people who are more risk tolerant. They're okay with volatility. They understand that things are going to drop sometimes, but they're more focused on long-term growth. So they're usually heavier in stocks and ETFs. And age plays a role too. If you're younger, you usually have more time to recover from downturns. So naturally, a lot of younger people take on more risk. But if you need the money sooner, you're probably not trying to take big swings. And there's no right or wrong here. You just need to invest in a way that you'll actually stick to. Now, here's where things start to fall apart for a lot of people. They skip everything we just talked about and they just decide to copy someone else. They see that someone online is making money from a certain stock or certain ETF and it looks good, so they jump in. But they're only looking at the gains. They're not looking at the risk that comes with it. Have you ever heard the saying, no risk, no reward? That's not just a saying. If you've been keeping up with the markets lately, you've probably seen that a lot of investments are lower than usual right now, and for some people, they're even in the negatives. And this is why your risk tolerance matters. Because higher risks, yeah, it usually means higher returns, but it also can mean bigger drops. And on the other side, lower risk can mean a little bit more stable, but also slower growth. So if you're investing in something a little bit more aggressive, it's not if it'll drop, it's when. You have to prepare for it because it's inevitable. And this is where people split into two groups. Some people see the market drop and they panic. They stop investing, they sell everything, they just want out. Other people see the same thing and they think, okay, everything's on sale right now, so they may even start investing a bit more than usual. And this is why diversification matters so much. I like to think of diversification in two ways. The first is diversification across investments. So think things like different stocks, ETFs, different industries, or even different markets. Diversification across different investments is basically not putting your eggs all in one basket. You may have a risky investment that may be down this month, while at the same time holding a less risky investment that may be up this month. And those two investments essentially balance themselves out where your portfolio isn't taking as big of a hit. Because not everything moves in the same way at the same time. So it helps reduce your overall risk. The next way to think of diversification is across different goals. For example, your retirement fund, you might take more risk with that one because you have more time. And usually retirement happens years down the line, so your money typically has time to recover from those ups and downs. Saving to buy a home in 5 years, you'll probably want something a little bit more stable. Because if the market drops right when you need the money, you don't have the time to wait for it to recover. An emergency fund, that probably shouldn't be invested at all because that money is there for immediate access. And the last thing you want is for the markets to be down when you actually need it. So you can actually have different risk levels across different parts of your life. And that's why some people panic when the market drops and others will see it as everything being on sale. So when people ask, how do I start investing? It's not just about picking something. It's about building a strategy that you understand and a strategy that you'll actually stick to, even when things are bad. If this video helped you understand investing a little bit better, make sure you like this video and subscribe. And let me know in the comments, are you someone who panics when the market drops, or are you buying more?